Hello. Sup everyone. So this is episode 2 of Macro from Zero. Episode 1 was about interest rates, and this one is about inflation. So if you didn't watch the first episode, I highly recommend to do that, as well as I highly recommend to join the free Discord. It's the first link in the description. And without more, we're gonna start. We're gonna just quickly recap. We're opening. So we covered interest rates, the most important factor. Blah blah. Don't move by themselves. Central banks raise and lower interest rates in response to data. And the number one piece of data that drives those decisions is inflation. Understanding inflation is understanding why the Fed does what it does. Sorry. And if you don't understand why the Fed does what it does, you understand why currencies move. In episode 1, we covered the engine, today we covered the fuel. So let's start with it. What is inflation? At its most basic, inflation is the rate at which prices rise over time. You've heard this in everyday life. Things are more expensive than they used to be. If a coffee cost $2 in 2015 and costs $4 today, that's inflation. The dollar has lost purchasing power. Each dollar buys you less than it used to. Central banks have a target inflation rate. For the Fed, ECB, and Bank of England, the target is 2% annually, not 0, 2%, because a small predictable level of price increases encourages spending and investment. Deflation, falling prices, is actually more dangerous than mild inflation. When prices fall, people delay purchases, business cut costs, the economy slows, and Japan spent 3 decades trapped in exactly this cycle. So the goal isn't zero inflation, it's stable low inflation around 2%. When inflation runs too hot, 5, 6, 7%, purchasing power erodes fast. People feel poor, wages don't keep up, political pressure builds, central banks are forced to act. That's when they raise interest rates. When inflation is too low or turns negative, central banks cut rates to stimulate spending. This 2% target is the engine behind every major central bank decision, and therefore every major currency move. So how inflation is measured? There isn't just one inflation number, there are several, and they matter in different ways. CPI is also as consumer price index, the headline number you see in the news. It measures price changes in a basket of goods and typical consumer buys: food, energy, rent, healthcare, transport. When you hear inflation came in at 3.2%, that's CPI. Traders also watch core CPI. This is more important, probably. Not probably, but actually, especially right now in the US, the Fed, which strips out food and energy. Why? Because food and energy are volatile. They spike in summer, crash in winter, swing with geopolitics. Core CPI gives you a cleaner read on underlying inflation trends. It moves slowly, but that's what the Fed cares about most. So yeah, that's what I said. PC, personal consumption expenditure. Sorry, I can't really read that. This is the Federal Reserve preferred inflation measure. PC is a broader basket than CPI and adjusts for changes in consumer behavior. If beef gets expensive and people switch to chicken, PC captures that substitution. CPI doesn't. PC typically runs 0.3 to 0.5% below CPI. When the Fed talks about their 2% inflation target, they mean PC, not CPI. This distinction matters when you're reading Fed statements. Wait, PC. I think that was supposed to be here, but sorry. Yeah, core CPI. They also target 2% there. PPI, producer price index. This measures price changes at the producer level. What manufacturers and wholesalers pay for inputs before those costs reach consumers. PPI tends to lead CPI by a few months. If PPI is rising sharply, it suggests CPI will follow, because producers eventually pass costs on. The most important, core PCI for Fed positioning, core CPI for the immediate market reaction on release date. Why Why inflation moves currencies. So now you know what inflation is and how it's measured. Here's why it moves currencies. The basic mechanism. Higher inflation forces the central bank to raise rates. Higher rates attract capital. Capital flows strengthen the currency. We built this foundation in episode 1. But here's the nuance that trips up most beginners. It's not about the inflation number itself. It's about what the inflation number implies for the central bank's next move. And more importantly, whether it surprised the market. The three key scenarios. Scenario 1, CPI comes in hot, above consensus. The market immediately reprices. It now expects the central bank to hike more aggressively. Fed funds futures move, bond yields jump, and the dollar strengthens, often 50 to 100 pips in the first 60 seconds after release. Scenario 2, CPI comes in soft, below consensus. The market reprices toward fewer hikes or earlier cuts. Yields fall, the dollar weakens, often just as sharp as a move in the other direction. Scenario 3. CPI meets expectations exactly. Almost nothing happens because it was already priced in. The market had already positioned for that outcome. This is the buy the rumor, sell the news dynamic we talked about in episode 1. The key is always the surprise. Always compare the actual number to the consensus estimate. Not the previous month. A 3.5% CPI reading means nothing without knowing whether the market expects a 3.3% or 3.7%. So you can actually really easily check this when you go to any news calendar. For example, I use Forex Factory. I think most of you do. And we can do this on unemployment. It doesn't matter. We can see NZD expected forecast is expected 5.4%, but the actual was 5.6%, which is bad because more people are unemployed. But we'll go this over in the next episode about labor market. But this is bad, and you see it was a surprise. So the market reacted more aggressively or sharply because it was not priced in. Priced in was this. This was priced in. This wasn't. So where were we? Why inflation moves? This, right? This is where we ended. I think so. Yeah, this is it. So the 2021-2023 inflation case study. The best real-world lesson on inflation and currencies happened right in front of all of us between 2021 and 2023. And if you understand it, you'll understand macro trading at a level most retail traders never reach. After COVID, governments and central banks did something unprecedented. They flooded economies with money, stimulus checks, furlough schemes, near zero interest rates, quantitative easing. At the same time, global supply chains broke down completely. You had a massive demand hitting very constrained supply. This result was inevitable. US CPI peaked at 9.1% in June 2022, the highest since 1981. The UK saw 11.1% in October 2022. The Eurozone hit 10.6% in October 2022. But here's what matters for Forex traders. The Fed was late. For most of 2021, Chair Powell called inflation transitory. They didn't raise rates until March 2022, months after the data was screaming at them to act. The market noticed bond yields rose before the Fed moved. When they finally moved, they moved fast, from near zero to 5.25% in just 16 months. The most aggressive hiking cycle in 40 years. The dollar reacted violently. The XI rallied from around 90 in early 2021 to 114 by September 2022, a 27% move in 18 months. The euro fell below parity for the first time in 20 years. Sterling hit a 37-year low. The yen lost over 30% of its value. All of it driven by one thing, the inflation rate differential story playing out in real time. If you understood the connection going into 2022, you had one of the clearest macro trades in generation. So how to trade CPI releases? CPI is released in the US on a fixed schedule, usually the second or third Wednesday of every month at 8:30 a.m. Eastern Time. It's one of the highest impact economic releases in Forex, alongside NFP and FOMC decisions. You need a process for this, not a hunch. Step 1. Know the consensus. Before the release, check what the market expects. The consensus estimate, Bloomberg, Reuters, and every major economic calendar publish this. It's the average of economist forecast. This is your baseline. Step 2. Know what's priced in. The consensus and what's actually priced in can differ. Check where Fed funds futures are trading. If the market is already fully priced in 3 hikes based on the current trend, a matching CPI reading won't move the needle. A surprise is what matters. So pretty much what I already said. Step 3. Prepare for both directions. Don't try to predict the outcome, prepare for it. Know in advance. If CPI comes in hot, what do I trade? If soft, what do I trade? Hot CPI, dollar positive, look to buy USD JPY, sell your USD, sell GBP soft CPI, dollar negative, look to sell USD JPY, buy your USD, buy GBP Obviously, don't just do this. This is just, something that came across my mind, but don't actually do this, just buying and selling all of this just because of one print. Don't do that. Step 4, wait, don't pre-position. The first 30 to 60 seconds after CPI hits are extremely volatile. Spreads widen, stop hunts happen, false moves occur, wait for the initial reaction to settle, let the market digest the number, then look for entry. Patience on release day is a skill in itself. The goal isn't to trade that first candle, it's to understand what that number means, and then position with a new narrative. So, little inflation toolkit. Here are the exact tools and release dates every Forex trader should track for inflation. US CPI release second or third Wednesday of the month, 8:30 a.m. EST time. Watch both headline and core. Core is what the Fed cares about. This is your highest impact monthly release for USD pairs. USPC released last Friday of the month, 8:30 a.m. Eastern time. This is the Fed's preferred measure. It tends to move markets less dramatically than CPI, but carries more weight before FOMC meetings. When the Fed says 2% target, they mean core PC. I think so. Yeah. Holy shit! I gotta get this right. I think it is because I had it here. But they also target 2% here on core. US PPI released roughly a week before CPI, a leading indicator. Hot PPI often signals hot CPI is coming. Soft PPI can front-run a soft CPI surprise. Watch it, most beginners ignore it. Break-even inflation rates. The difference between nominal treasury yields and TIPS yields. This is the bond market's real-time expectation of future inflation. The 5-year and 10-year break-evens are most watched. If break-evens are rising, the market is pricing more inflation risk ahead. Dollar bullish if they're falling. The market sees inflation coming under control. Can be dollar negative. This is a live daily signal, not just a monthly release. University of Michigan Consumer Inflation Expectations. A survey published every 2 weeks shows where consumers think prices are heading. The Fed watches this carefully because anchored expectations matter. If people expect inflation to stay high, it tends to become a self-fulfilling. Workers demand higher wages. Business raise prices. Set alerts for all 5. These are your macro calendar anchors every month. So conclusion, let's bring it all together. Inflation is the rate at which prices rise over time. Central banks target 2%, not 0. When inflation runs hot, they raise interest rates. When it runs cold, they cut. The currencies of central banks fighting inflation aggressively tend to strengthen. The currencies of central banks falling behind tend to weaken. CPI is the headline number, the one that moves the market on release day. PC is what the Fed actually targets. PPI leads both, and what matters more than any absolute level is whether the number surprised on the market relative to consensus. The 2021-2023 period gave us a masterclass, the biggest inflation surge in 40 years, the fastest hiking cycle in 40 years, one of the strongest dollar moves in 20 years. The connection between those 3 things is not a coincidence. It's the mechanism we cover today. Add this to your monthly calendar, PPI 1 week before CPI, CPI mid-month, PC end of the month. Track break-even rates daily. Watch UMI every 2 weeks. These 5 data points will tell you more about where the Fed is headed than 90% of the commentary you'll read online. In episode 3, I'm not sure what we'll cover, but I have this here because how to amend the employment. I think we'll go over labor market. So yeah, so this was inflation, and the next video will probably be about labor market, because that is also very important for the interest rates. And after that, it will probably be yields. But stay tuned, and yeah, this was episode 2. And yeah, see you next time. Bye.